Welcome to Accounting Actuals. We simplify accounting and bring practical insights on the financial tools that every business needs. Before books are sent to the tax preparer, the year must be properly closed. In this video, we will outline for you the steps required to close the books correctly, ensuring they are clean, locked, and ready for tax. Step 1. Set year-end cutoffs. First, set your year-end cutoff rules. This step creates discipline around transaction timing and ensures consistency before any year-end entries are processed. Year-end close is based on the company's established fiscal year-end, which may differ from the calendar year. All accounting activity must comply with this defined cutoff to ensure transactions are recorded in the correct period. Without a clearly defined cutoff, transactions can be recorded in the wrong period. Your year-end cutoff should include the following: last date for invoices, last day for expenses, shipping and receiving cutoff. Step 2. Close revenue. This means making sure everything you earned during the year is fully recorded and properly applied. To close revenue means you send final invoices, post all deposits through year-end, reconcile accounts receivable, clear unapplied cash. Step 3. Close expenses. Now, close expenses and accounts payable. If expenses aren't complete, your taxable income and your 1099s will both be wrong. This is one of the most common places companies rush and regret it. To close expenses means you enter all vendor bills, accrue missing expenses, reconcile AP to vendor detail. Step 4. Reconcile banks and credit cards. Reconcile every bank and credit card account. This step proves that what's in your books matches what happened in real life. If something doesn't reconcile, stop and fix it before moving on. Match to final statements. Clear old outstanding items, like reissuing old uncleared checks. Step 5. Clean up suspense accounts. Clear out all suspense and uncategorized accounts. These accounts hide errors and always trigger extra tax prep questions. If you can't explain a balance, it shouldn't be there. These include uncategorized expenses, uncategorized income, miscellaneous accounts, ask my accountant balances. Step 6. Payroll and contractors. Review payroll and contractors. This is where W-2s and 1099s are either set up for success or guaranteed problems. You should reconcile payroll reports, confirm bonus accruals, separate employees from contractors' pay, verify W-9s. Step 7. Review fixed assets. Large purchases need to be classified correctly before depreciation is calculated for tax. Anything misclassified here will affect multiple tax years, not just this one. To review fixed assets means you identify capital purchases, remove disposed assets, prepare asset list. Step 8. Loans and interest. Review all loans and debt. Balances and interest expense need to agree with lender statements before tax prep begins. This also avoids last-minute questions about unexplained balance sheet changes. You should reconcile loan balances to statements. Record interest expense through year-end. Step 9. Equity and owner transactions. Clean up equity and owner activity. These transactions don't hit the P&L, but they absolutely matter for tax reporting. They are also an area that tax preparers always review closely. This means owner contributions, distributions, or draws personal expenses paid by business. Other steps include, if applicable, additional year-end close steps may apply depending on the nature of the business. These can include inventory counts and year-end inventory adjustments, as well as the reconciliation of sales tax and other statutory liabilities. While not applicable to every organization, these areas should be reviewed and completed where relevant before the books are finalized. Step 11. Final financial review. Do one final financial review. This is your chance to catch issues before they turn into tax problems. Look at the numbers like someone seeing them for the first time. You should scan P&L for unusual activity, check balance sheet for odd balances, compare to prior year. Step 12. Lock the year-end package for tax. Finally, lock the fiscal year and prepare the tax package. Once the year is locked, no additional transactions may be posted to that period. The year-end close should be formally communicated to confirm that the books are final and that no further changes or accounting activity may occur in the closed period. Lock the accounting period and pull final financial statements, GL reports, reconciliation reports, 1099 report to your tax preparer. Was this helpful? Don't forget to subscribe for more business finance tips that actually make sense. Thank you so much for watching. For more information on how we can support your financial goals, be sure to check the details in the description below or visit our page.